I would say it's both. We both build that into the technology, but I think it's a continuous earning by the industry as well. So when we look at the financial industry today, what we see as a shift is that the payments and compliance are no longer separate. And I think this creates a big shift in the way that today a static compliance rule-based needs to evolve. And we see more and more compliance becoming as part of the transaction flow in order to establish a trust that the industry needs today with regards to the emergence of this new technology. More particularly, I think when we look at a bit the way that compliance is happening today, is that the trust is verified after the fact when the payment is done. Whereas when you are moving to the real time, there is no longer about detection, it's about really prevention. So this creates, I would say, different needs in terms of how you manage your compliance. So we see basically a move from very static or verifying or checkpoints compliance into a more decision-based, based on data, based on identity and real-time monitoring of risk that happens throughout the moment that the transaction is still happening. And this is, of course, very complex because instant payments is about, I would say, instant, right? So this intelligence needs to really be strengthened. And what we see in the, I would say, in the regulatory angle is that more and more, at least in Europe and other places, we see that the regulators are pushing to that. So there are solutions like verification of the payee, confirmation of the payee. These are behaviors that shows that we are not looking at a static rule-based. The decision about a fraudulent transaction or identity is already integrated at the early stage of the transaction. So the transaction would not go to the execution unless the identities and compliance information are verified. So I think that's a big shift that we see. And as I would say, as a provider of the compliance to multiple networks that are emerging, we are trying to make sure that as this new real-time, I would say, infrastructures are becoming more and more prevalent, we are just making sure that our participants and our banks are managing the cross-border, the domestic, I would say, complexity by bringing the compliance in a real time throughout the whole transaction lifecycle.
I think on the market, right, as we move from the traditional lower volume of payments to high velocity, huge volume of digital payments supported by the new age of technologies, I think a natural concern will be, if anything goes wrong, will the sort of a damage also be amplified, which lead to the natural question of, can we still trust the system, trust the bank, right? In my view, the digital trust probably covers both aspects of your question. Firstly, from a development and design point of view, the technologies we're going to adopt should also essentially accommodate the increasing demand of supporting digital volume, high velocity, low latency, high capacity payments. So essentially, it's part of the design principles we need to adopt. We need to adopt new age control measures to ensure the system by design, by development can support higher level of trust from the users. Another part essentially is really the way we manage the whole process, engaging with clients. The principles we set up in our product design, development, and long-term maintenance needs to give the comfort to the end users, our clients, the confidence that they can use the products in a very safe, secure, and sustainable manner. So it's both by design with a better technologies, better controls, and also we need to earn the trust by demonstrating we can truly drive toward that direction to give the confidence and trust to our clients.
Well, I strongly believe that trust has to be earned. And that's really important in the context of payments. At Swift, we've been earning the trust of our customers for over 50 years, and we're continually investing in operational excellence to upgrade our capabilities so that the payment experience is always secure, is always resilient. Today, we operate at what we call 4 nines of availability, so 99.99% available. And we're continuously conducting exercises like business continuity exercises to ensure that that availability is maintained now and into the future. Our network today sees something like the world's GDP equivalent over it every 2 to 3 days. So we're really operating at a very large scale here and really helping power the financial ecosystem. Alongside that, it's a network that operates at speed as well. So today, 75% of the payments that we see over the SWIFT network arrive at the end beneficiary bank within 10 minutes, often within seconds. And so we're combining the speed, the scale, and the availability to ensure that we do fulfill the trust expectations that our clients have and their clients also expect. Now, you mentioned the ISO 20022 payment standard. That is very important. We completed the migration to that in cross-border payments last year, and we're continuing to make full use of the capabilities of ISO 20022. And today we see about 97% of payment instructions on the SWIFT network made in that format. And we firmly believe that that can be the common language for payments going forward. So yes, there is trust based in the standard, but trust is also earned through the trust placed in institutions. And maybe one last point on this trust angle. As we go forward, we see different and new capabilities from new technologies emerging. So maybe in the future, trust can be also verifiable using the technology as well as being placed in the institutions that operate that technology.
When speed meets national interest, the answer is not to push for a single global network, right? That, I think, if you look at, I would say, national interest today, this is the part of the landscape, in terms of the data, in terms of the regulation, in terms of the sovereignty. And let's face it, we will end up with multiple networks. And that's why we believe that interoperability is more important than uniformity. And I think that would be the challenge of how we will manage this interoperability. And we see that in initiatives that it is in the market, when we look at the emergence of the DLC, that it is probably the very global emergence of the technology, and the complex solution like the one that it is built by SWIFT, this shared open ledger, it created a certain complexity that it's at the same time is very important because it shows that the direction is the right direction, because that means that an organization like SWIFT, with the scale that they have today, they will enable a real-time cross-border. But the value it comes also as well, how you integrate the domestics reality into this, I would say, journey. Our vision is more around how we can make trust as mobile as the value. Because so far, all these initiatives or these technological shifts is around the move of value, but the move of trust is not as advanced, I would say, as the move of the value. So I think that's where we want to put our efforts in bringing these two at the same level of the mobility.
The reality is highly unlikely that whole globe can align to just one single instance of a global network or global ledger. For various reasons, including the so-called national interest, right? Different places driven by government, by regulators, different setup, different networks or ledgers might be established to sustain the fundamental infrastructure, which is very normal. Even we look at a traditional banking world, right? There are many different clearing systems coexist. I think for clients, first of all, they need to have their design principles driven by the regulatory standards, the technical capabilities, and also the commercial interest, business case behind the development. And the second thing is get ready. It may not be a one-size-fits-all solution. Dealing with certain level of fragmentation and get interoperability capability ready, support multi-networks, support multi-chain, multi-ledgers, probably will be inevitable down the road.
At SWIFT, we've been connecting up the world for the last 50 years. Secure connectivity is what we're about as the world's largest financial messaging provider. And so as we go forward, We think it's incredibly important that that world becomes more connected as a result of all the rise of new and exciting technologies, new and exciting digital assets and digital money. And so we want to see that world become more connected. We want to see that world not become fragmented due to all these exciting innovations that are happening. And so we've really strongly focused on this big word of interoperability. And what that really means in practice is being able to ensure that the new digital networks can talk and work with each other, as well as, equally importantly, the new digital networks working together with the existing payment systems, which will undoubtedly exist for many years to come. And we've already demonstrated that we can execute this capability. We've done that through experimentations and more recently live trials. So we know we can do that, and we will continue to bring interoperability as a capability to our financial community. And so most recently, we announced a blockchain-based ledger, which will go on top of the SWIFT network. We're now moving into the MVP phase of that initiative, and that ledger is designed with interoperability at its heart. And that's going to be really important as we seek to deploy those capabilities to build the financial infrastructure of the future.
Time has been actually played the role and the mechanism of the control in banking. Now with the emergence of the real-time payments, the buffer doesn't exist. And it's probably very childish to think that everybody would be in the same speed of managing control. So I think the question is not about control, it's about redesigning the control and making sure that this control is adaptable to the requirements. So where we are seeing actually I would say the challenges is the fragmentation that exists today in the market. And this fragmentation is essentially means that most of the financial institution today operates in a very isolated or disconnected systems. Even throughout the payments, AML, fraud or screening, they are still isolated systems. This could work in a very, rule-based model, right? So you don't take the risk, right? You have the time. But with the real-time payment or settlement, the time is basically an instant. And what we see today is the design and the control works when you remove the fragmentation, right? So that you don't look at just payments as a way of sending a value. You look at it as how you can integrate or embed the compliance or identity layers within the payment itself. And that's where I think is not about really speed bringing systemic risk, is the control that you have and how far you go further to fragmentation and interoperating different systems, even within the financial institution, would be very helpful to remove these challenges.
The slowness wasn't really by design, right? In the past, when we structure payment solutions, probably from both compliance requirements and technological readiness point of view, it wasn't really, in many occasions, possible to design the full end-to-end streamline experience. Therefore, that slowness was probably perceived as a disadvantage of certain solutions, which certainly helped from a risk management point of view. If anything goes wrong, you have the lead time, buffer time to do the troubleshooting, right? But as we actually gradually evolve into fully digitized, high-speed, high-velocity payment types, I think that whole philosophy behind risk and controls also needs to evolve. We cannot actually design the buffer time to do the troubleshooting. We have to ensure end-to-end process is properly reviewed, and by design, by development, we add in the proper controls from a system and a workflow point of view to ensure that potential hiccups shouldn't happen and wouldn't happen. So in a way, essentially, it's not like we specifically remove the slowness. It's really by design. That kind of things shouldn't exist. That's not a solution for this, right? the proper control, end-to-end security standards, embed all the control measurements into the processes will be probably most critical thing we need to do.
Innovation without a real value to the real economy doesn't make sense, and it doesn't really work. The idea is not being, very optimistic that everybody would work in a complete perfect system. There will be a combination or coexistence of some of this very digital native or advanced technology, but with the existing and traditional access. And the idea is not to replace one with another, because this is impossible, it will take years. It's basically the challenge is how you can interoperate them. And there are, I see two big problems that today the industry is facing. First of all, there is a lack of interoperability between these digital ledgers that are emerging in the DLT, on-chain, off-chain, and the banking systems. And then when you look at this whole chain, you realize that if you want to really move that to a scalable model, so you need to remove these frictions between systems. And I think what could be interesting in the way that Swift is looking at this shared ledger is how you connect this, I would say, domestics to the real-time cross-border that would bring value. Second point that I think is really complicated is the fact that the compliance and checks are recreated in every step. It's like you are rebuilding trust in every institution, in every jurisdictions, or with every counterparties. This could work in a batch model, right? But it cannot work in an instant payment. So I think this is very important. That's why we see in a local context, if we look at the European context, SEPA aims that it is really a driver of the competition into the market and opening the door to many new entrants, is adapting the speed with what is required as a security. And solution like validation of payee that we are working hard, quite extensively with our community is really helping to bridge the gap between speed and security. So not really somehow trying to jeopardize the innovation, but giving what the market needs by the regulatory, I would say, directives that gives, the incentive of the community to adopt this, I would say, this behavior. So when we look at these last miles, and when we look at this complexity that it is coming with the emergence of multiple networks, digital networks, traditional wallets, how you connect account structure to wallet, these are the very important elements that today big financial institutions, they are not yet ready for this change. So we think that, and more we are working with our community around the concept that it is compliance passport. Compliance passport is really bringing the new technology in identity. So that means the verifiable identities embedded into the transaction itself. These are part of the regulation. For instance, in Europe, there is a regulation EIDAS2 with a clear deadline that it is now pushing in Europe financial institution to implement and integrate it. This is a very important entry point because this technology is based on verifiable credentials. It could maintain the privacy that an individual or a corporate wants and just verify the information that is required in the transaction itself. So the more we go towards this intelligence of verification, and moving the compliance data together with the transaction itself, I think we are closer to the interoperability vision that everybody is talking to that, because identity is the essential part of that.
We have seen like digital payment tools, especially like cryptocurrencies, stablecoins are already being used by individuals in many jurisdictions. Although the regulatory environment has been developing to support that kind of use cases, to really enable institutional clients to ride on the same infrastructure, same approach, supporting their needs. I think the current workflow design, current model probably still got a big gap to be filled, right? At the institutional level, when we move value from A to B, essentially we need to provide full accountability of the risk and the governance, transparency of the movement, traceability and certainty for institutional clients. These are inevitable. That cannot easily be done by just giving them a wallet. We still have to overlay a lot of controls to ensure the compliance standards can be followed. Liquidity movement behind the scene can be properly handled, and we will need to also provide all the necessary audit trails and information exchange back to institutional clients. So when we actually adopt a new type of digital currencies for the institutional usage, I think the important thing is we need to understand a lot more controls and governance will need to be overlaid to support those kind of use cases.
We already operate at speed at SWIFT, with 75% of those cross-border payments reaching the beneficiary bank in 10 minutes and often within seconds. Yet alongside that, we also see that 80% of the transaction time is in the last mile. And so the last mile is really important. And what do we mean by the last mile in this context? Well, it's basically the time taken from the money to arrive at the beneficiary or destination bank, and that to be then credited to the account of the end user. There's no single reason for that time taken. There are multiple different reasons which are often determined by local market practice. So we see things like operating hours, foreign exchange, conversion, local market norms, if you like, around when the beneficiary should be notified that a payment has arrived. So these are all kind of examples of things that can slow a payment down. And so the way to tackle this, and what we're doing, is really working very intensively with the local financial communities to solve those pain points and improve the payment experience. Alongside that, though, we have two big initiatives that we're working on at the moment. I already mentioned the blockchain-based ledger, which is really about creating the rails of the future. And together with that, though, we are still uplifting the payments experience on the existing rails, and that is an equally important initiative that we have ongoing at the moment. So that initiative is we call the Payments Scheme. It's about creating a framework where ourselves and the banks involved commit to certain expectations around the payment experience for consumers and small businesses alike who they're serving. And what does that really mean in practice? It means that there can be confidence that, for example, there will be a full value transfer. In other words, if I send you $100, you will receive $100. It means upfront transparency of costs and the foreign exchange rate. And it means that when an instant payment system is available, that will be used. So the customer will get the fastest way to have their payment delivered. And so we have the global financial community really engaged in this initiative, and around 25 banks have committed to go live with this framework by June. And over the course of the year, we'll be adding more corridors, more currencies, more banks to really focus and ensure that the payments experience is really uplifted for end consumers.
I think it's no longer about how fast value moves. I think it's how confident when we pay. I think the story is around the fact that the fraud and compliance is becoming more and more sophisticated. And we see in certain instances, for instance, you have some authorized push payments. The hackers are not just going to systems. Hackers are going to individuals, even showing a legitimate pushed instruction, but manipulating. So the behavioral parts is becoming more and more important. That's why I'm saying, with what level of confidence are we moving? And as we are going to this connection between domestic and cross-border, the complexity of, I would say, compliance would be more and more. So we see that hopefully in 5 years, the world could have, the payments, at least the transaction life cycle, is no longer about the fragmented compliance systems. It's around more, I would say, shared view of the trust. And that's why our vision around the compliance passport is how we remove this fragmentation by a identity that starts from the initiation up to the end and enables to move from one network to another without, the challenges that could bring in the regulated finance?
It's very difficult to just use one metric to evaluate the success, right? If I have to say, probably the best way to say is really the client experience, but that will cover a very broad aspects of potential criteria, right? Are we able to provide the full comfort to every checkpoint? They got information they need. They have the full confidence and trust of the flow we have commonly designed to support that use case. And also, from a risk and governance point of view, are we able to meet all the compliance and regulatory requirements and provide evidence how we can achieve that, right? Probably a combination of all of this can give us a better indication whether that is becoming mainstream, if we claim becoming a mainstream payment instrument as a sort of a success for this kind of a development.
In 5 years, I think success will be defined in a number of different ways. I mean, first of all, we're really laser focused on improving the speed, transparency and cost of cross-border payments. And that's a really important priority for the global financial community. And it's also a really important priority for policymakers who define targets for consumer payments through what are called the G20 goals for consumer payments. And we are really, working very hard to support and enable the financial institutions to achieve those targets. So those targets are very, very important to us, and we're really working hard on them. Equally, I'm a motorsports fan. The drivers are constantly trying to go the fastest possible, but also stay on the track. And so there's a bit of an analogy there to what we're trying to achieve in payments, because we want that payment to be as fast as it can for the customer. Equally, we need to have that payment guaranteed to reach its destination. We need to do that securely, and we need to ensure that payment is made in compliance. And so we're constantly prioritizing both things: the operational excellence around that security, that resilience, that compliance, and also ensuring that the customer receives the best possible payments experience. As we look forward, we also think about the power of new technology. And we don't just think about that, we actually do it. We integrate new technologies into our network. And that's what we're doing at the moment with our blockchain-based ledger. And the way we approach that is to really think about how we can take the best of what's in the system today and add the opportunities that new technologies like blockchain give us. And so we see a world where we're going to create the future of financial infrastructure by putting the best of both worlds together, the existing and the new. And that makes me really excited about how we can really, over the next 5 years or so, really uplift that payments experience.